Have you ever wondered how the abstract world of Wall Street finance actually connects to your life, to your kitchen table? Well, it turns out there's this hidden, high-stakes system that links the two, a system built on something called phantom assets. Today, we're going to pull back that curtain and really dig into its secret cause. Okay, let's just dive right into this idea. This question, it's not just for a book cover, it represents a totally real, kind of mind-bending concept at the very heart of modern finance. We're talking about a world where a single asset can be promised to many, many different people all at the same time, creating this kind of financial hall of mirrors. So how does this hidden machinery actually work? It all starts in what feels like this distant, complex world of high finance, but as you're about to see, its gears are turning a lot closer to home than you probably think. Right, imagine you lend your car to a friend. Simple enough. But now imagine your friend then lends your car to someone else, who then lends it to another person. That's pretty much what's happening in the financial system. Banks are taking assets that don't even belong to them and using them to back their own loans, creating this long and incredibly fragile chain of promises. Yeah, there's a technical term for this, and it's a mouthful. Rehypothecation. It's a really fancy word, I know, but it boils down to a simple yet pretty risky idea, using the very same asset as a promise for multiple different loans, all at the same time. And here's exactly how that chain reaction gets going. A client, let's say a big hedge fund, pledges some assets to a bank. But then, and this is the key part, the bank turns around and reuses those exact same assets to get its own loans. And the next bank can do it again. See how it works? This is how one single, real asset gets multiplied into a whole chain of phantom assets, with each link just being a promise built on another promise. So what's the big deal? Well, the system becomes dangerously over-leveraged. It creates what's called a liquidity illusion. It looks like there's plenty of cash to go around, but if a panic starts and everybody rushes to grab their collateral at the same time, they find out it's not actually there. And when that chain snaps, like it did spectacularly during the 2008 financial crisis, the consequences are just catastrophic for everyone. But the fallout from that crisis revealed an even deeper connection, a link between Wall Street's phantoms and the very real struggles of everyday people. And this is where the story really pivots, because this isn't just about giant Wall Street banks and hedge funds. We're about to see how the exact same logic that creates these phantom assets in the financial system has a very, very real impact right there at your kitchen table. Over the past few decades, the logic of Wall Street is kind of seeped into every corner of our lives. It's a process that academics call financialization. You see, starting around the 1980s, as a lot of social welfare programs were scaled back, personal debt stepped in to fill that gap. Think about it. Housing, healthcare, education, the absolute basics of life are now things you increasingly have to access through financial products. We've shifted from what was called a welfare state, where the government provided the safety net, to what some now call a debt-fare state, where we're all sort of expected to go into debt to secure the basics for a good life. And this quote from Mauricio Lazarado just nails it. It forces us to completely flip our perspective. He's saying that for most of us, finance is just a fancy word for debt. It's the same system, sure, but seen from the bottom up, from the point of view of the people who actually have to worry about repaying it. And once you make that little shift in perspective, something incredible is revealed. You realize there are two sides to every single debt. There's the financial product that we can see, and then there's this whole hidden world of human effort that stays almost completely invisible. This iceberg model is the perfect way to picture this hidden reality. Above the water, you've got the formal world of finance, the loans, the credit scores, the investment portfolios. But below the surface, well, that's where you find the vast, unseen world of human effort that's required to manage all that debt. I mean, look at this stark contrast between these two worlds. The visible part is all objective and numerical. Credit scores, loan amounts, that kind of thing. But the invisible part, that's emotional, it's informal. It's the worrying, the constant budgeting, the sacrifices, the side hustles. All of this is the unpaid, unmeasured work that actually keeps the whole system afloat. So let's go deeper. Let's dive into that submerged part of the iceberg, because what researchers are finding is that it's a form of invisible labor, the kind of work that allows our entire society to function day in and day out. This is what's now being called caring for debt. And it's so much more than just paying bills. It's the mental toll of worrying. It's the endless calculations of budgeting, the sacrifices you have to make, the sheer endurance it takes just to get by. This is a form of constant unpaid labor that keeps households going. And here's the kicker. This hidden work doesn't just benefit the household, it directly produces value for the financial system itself. It makes up for reduced social services, and it makes sure those mortgages and credit card bills get paid. It's this vast, unacknowledged subsidy of human time, energy, and, well, care. So this leads us to the most important question of all. If the entire financial system is being propped up by all this invisible labor, what happens when that well of human care just runs dry? What happens when we just can't cope anymore? The feminist scholar Nancy Fraser actually has a name for this. She calls it the crisis of care. It's that breaking point where the demands of our financialized economy just completely exceed our human capacity to cope. And now we can connect the two parts of our story. We started with the systemic risk of phantom assets floating around on Wall Street, but what we've discovered is another, maybe much more fundamental risk, the pure exhaustion and burnout of real people. The fragility isn't just in the numbers on a screen, it's in the exhausted bodies and minds that are keeping the whole system from collapsing. And that's really the final thought I want to leave you with. It forces us to completely reconsider the whole equation. If our entire financial system truly runs on our hidden care, our worry, our sacrifice, then what is the true cost that we're all paying?